Welcome back to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and that guy is...
Brian Leverage.
Correct. Nice work, Brian. So, what are we talking about today, Brian?
Besides remembering my name, we're going to talk about the 5 important things to know before you invest in real estate.
So, five. So, stick around to the end of the video and make sure you catch all 5 important things to think about before you invest in real estate. And we're going to cover that right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
Welcome back. So, Brian, 5 things.
Yeah.
5 things. What is the number one thing you must think about before you invest in real estate?
Well, I don't know if we're ranking these in any particular order.
The order that we're naming.
But the order we're going to discuss them in, at least.
Yeah, what's the first thing that you want? Where?
Yeah.
Where? Like wherefore art thou?
I was thinking more in the real estate sense instead of the Shakespearean one.
Kind of like, do you want to invest in Chattanooga, Tennessee, or do you want to invest in Phoenix, Arizona, like one of our other guests?
Yeah, the property is it's really a secondary or frankly tertiary concern, because when we're real estate investors, we're investing in markets, right? Because there are things that drive real estate growth, rent growth, etc. And it's important to be able to identify those as investors, to set yourself up for the most success.
Yeah, and actually that sort of goes along with one thing that one of my professors says, which is that real estate is a series of cumulative knowledge. And the more time you spend in a market, the more expertise you get. And you really should strive in real estate to be the world's foremost expert in the particular market that you're in. And by that, he doesn't mean you have to know more than anyone else in Chattanooga about real estate, but that if you're going to pick a specific street and you're going to buy a specific property type, which is the second thing we're going to talk about, is kind of reveal that a little bit, then you could be the expert in, like, say, duplexes off of Highway 58 in Chattanooga.
Well, sure, yeah. It boils down to identifying the market, and then in any market, there are what we call sub-markets, right?
Sure.
So larger areas, generally driven by zip code, or defined by zip code, right? Some areas are certainly going to be better than others. So you, as an investor, have to define what areas you're willing to put your money into.
And you can refine this as narrow as you want. You can say, hey, I'm only going to invest in this city, this region, like, the Southeast, this state, or this zip code, or even this street or this block, or whatever whatever, these 3 houses and that's it. You get to define this yourself. And so the first thing we want you to think about is, where do you want to invest?
Right. So I think we've covered the where.
Yes. The second one is, what do you want to invest in, which I kind of tipped our hand on a moment ago when I said duplexes. But this is really a question of, like, what asset type you want to do. And we've done a whole video about this, which we'll put above our heads here. But basic idea here is, do you want to invest in single family, multifamily? Do you even want to be in residential? Maybe you want to be in commercial property or something like that. So you have to think about, for your unique strategy, what type of asset you're looking to invest in.
Yeah, the important in understanding the difference is that there are different risk profiles associated with all these different asset classes, right? So, like, a house typically is the cheapest entry point into investment real estate, right? But its value is not derived from the rent it produces. It's derived from a comparable sales approach often.
Absolutely. And of course, even in single family housing, there's different subclasses. Like, some people like to invest in tiny homes, or some people like to invest in condos. So you have to really think about, like, what your strategy is. Brian and I, currently, our strategy is a little eclectic, I would say. We invest in multiple different asset classes, but in a way, that's all part of our strategy. We're investing in certain price points. So you can define that as, I only invest in single family, but you could also say, I invest in stuff between $1 million and $3 million in Chattanooga.
Yeah.
Right. And there's an advantage to that, because you can get to know that piece of the market really well. So,
exactly.
So that is the second thing that you need to think about before you invest in real estate. Now, Brian, what is the third thing you need?
It's kind of a big one, money or capitalization.
Right. Like, do you have enough? How much do you need?
Well, That varies, obviously, but I think the more important issue to address with respect to capitalization is not so much down payment, which is frankly what a lot of people tend to focus on is, well, I've saved up enough, I've got 25% down to go buy this house, duplex, or whatever. The problem that they often miss then is operating reserves, because it may be vacant for a period of time, or
CapEx reserves,
expenses. Yeah, you got to build those things up over time.
Yeah, so the thing is, if you're a new investor, it's really tempting to say, okay, my bank says if I have 20% down, I can go buy this single family house, and maybe it's a $200,000 house, so you save up $40,000, and now you're ready to go buy this property, right? Maybe even have 45 or something, so you have a little bit of a cushion. And that works out really, really well if nothing goes wrong.
Sure. And a lot of times, as a rule of thumb, just when starting out, you often want to have 6 months. This is what lenders look for, right? Of your principal and interest, taxes, and insurance, essentially, as a savings or operating reserve for your property. But then you have to also look at things like when you're buying it, how old is the roof? How old is the water heater or the heating and air? Because those are the bigger ticket items that you're going to have to replace sooner rather than later.
Right, and if you have to replace an HVAC system for $6,000 or something like that the first week, and your rent's $1,000 a month, and you don't have an operating reserve, you're in trouble. Yeah.
And then I think the last piece with respect to capitalization is that once you've bought it, and once you've even planned for these sort of things, roof replacement, etc., there's also a continuing, ongoing reinvestment in the property. Design characteristics change over time. So what's popular now may in 5 or 10 years not be the case, right? So paint schemes, right? Changing color. I mean, you're going to have to paint a place anyway, but then you might look at changing out flooring, even though the floors you have are in,
And this becomes a real issue when you're talking about things that last a while, right?
Yeah.
Like floors, cabinetry, backsplashes. Things that really don't get replaced all that often. They can look very dated very fast. And so you need to be thinking about what's the cosmetic aesthetic of the particular property.
Because as we also discussed in a previous episode, right, there are ROIs based on CapEx investments, above and beyond that you can generate by having a fresher product, right? Higher rent, lower vacancy, etc.
Yeah, so I think the point is you have to be thinking about how much money you actually need, and it's more than just your down payment, and it's more than just a standard operating reserve, and it's going to depend on your situation too. If you're someone who has a lot of liquid capital, you might not need to necessarily move that capital into your operating reserve for a particular investment, because if you have access to it, you have access to it.
Yeah.
But what you don't want to do is be someone who goes, well, I've got this line of credit, and I can use the line of credit to cover this stuff, which may be true, but in some situations
that's
that
actually
changes.
called debt.
Yeah, well, and there's nothing wrong with financing operations through debt as long as it's part of a broad strategy and you think about it clearly. You need to think about the risk associated with that and decide if it's something you're willing to do, and that's probably beyond the scope of point number 3 here. And now a word from our sponsors. Who's sponsoring us today, Brian?
Well, we are, Jeff.
We are. How amazing. So we want to tell you about how you can save an enormous amount of money on your taxes and how Brian and I have been able to eliminate our taxes entirely.
You guys need to learn about cost segregation, which you can do by going to our website, oldfashionedtaxsavings.com.
Yes, and if you go there and you fill out the form, you can get a free, no-cost benefit analysis that will show you how much money you can save and what it will take to do that. So let's move on to number 4.
Which is operations.
Yes, and this does flow very nicely from what we were just talking about. So when you're thinking about operations, there's one big thing you have to think about first, and that is, are you going to hire a property manager?
Yeah. I would argue, and I've been saying this for years, and I'm biased as somebody who actually owns a property management company himself, in that a good property manager will help you scale, right? And get, which frees up your time, allows you to go find more opportunities. A bad one, on the other hand, can cost you everything and then some.
Yeah, you hire the wrong property manager when you only have a few properties and you're out of business.
Yeah.
If you have a lot of properties and you hire the wrong property manager, it's very painful, but you probably can make an adjustment and get a new property manager.
Sure.
But if you're on 1 or 2 properties and you lose out on, all of your revenue for a period of time, you can be toast really fast.
Yeah, I think really the main point here is that operations are probably, a lot of people say you make your success is determined at the closing table. That is very important, but if you're a bad operator, it almost doesn't matter what you paid for the thing in the first place.
No, well, we've bought properties and we've been very successful at the closing table because the person that owned the property was a bad operator.
Yeah.
So the thing is, like, what you pay for a property matters, but if you don't operate it correctly, what you paid for it can be a double-edged sword. I mean, you might say, hey, this property, it should be worth X dollars. I'm getting it for, Y dollars, some lower amount. But if you run the property into the ground after that, it's not going to matter that you got a good deal on the property.
And in this part of the real estate cycle, where I don't think anybody would argue that we're well into expansion, possibly even equilibrium. Who knows?
Or hypersupply, or one thing we know is we're not currently in a real estate market crash. Like, we know that. But listen.
But where prices are inflated like this, right? Operations become even more important because generally your margins are going to be narrower at a time like this.
They certainly can be, unless your income is increasing along with the property price. And that's something that operations will help you keep a little bit closer to parity, which actually brings us to the fifth, Brian. That's 5. That's every finger I have on my hands. That's why we're going to quit after this one.
Yeah.
The 5th thing you have to think about before you buy, and this is counterintuitive, you need to think about how you're going to get out. How are you going to exit from that property? Most people say, well, I'm going to buy it and I'm going to hold it. Well, that's fine. There's nothing wrong with a buy or hold, or for that matter, there's nothing wrong with flipping, as we've discussed in previous episodes. But it's important to understand what the possible ways to get out of it is, whether it's going to be through a refinance, through a sale, or through some type of long-term hold and amortized.
Well, I think the exit strategy helps a person to define why they're buying something in the first place, right?
Yeah, it's their why.
Yeah.
What are they looking for?
It's I want to buy real estate. Okay, well, that's great. Like, what do you hope to accomplish by buying real estate?
It is really sexy, right? Just to own real estate automatically makes you cool. That's what I always say.
Look at what it's done for us.
Yes, 2 of the coolest guys in the world. But the truth is, like, if you understand what your goals are, it matters. I had this discussion with a new investor just the other day. He's in the process of moving to Central Asia for his job, and he wants to start investing here so that in 10 years he can retire. And he's like, I really want cash flow. But does he really want cash flow? He's got a good job. Maybe what he actually wants is the highest return on investment for the next 10 years so that he can have cash flow 10 years from now.
Yeah.
And people don't always think that. They're like, I want to replace my income. Well, that's certainly a reasonable goal. But if your goal is to replace your income 10 years from now, then you might not care about cash flow today. Obviously, look at the 4 sources of real estate returns and understand that cash flow is a measure of safety. So you do want some cash flow no matter what, because otherwise you're going negative, and that's not good. Mm-hmm. But anyway, so you got anything else you want to share about that?
No, we talked about 5 things. That was 5.
That is. So thank you for sticking around to the end of the video. And as promised, we shared all 5 of those things with you. Be sure to like our content, subscribe, share, do all that kind of fun stuff. Cheers.
Cheers.